This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
I want to move on to our post-game chart deck, which is titled Sizing Up the Markets and Emergent Trends. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to your homepage, macrovoices.com, look for the button that says Looking for the Downloads. Patrick, let's take a look at the chart deck. Starting on page 2, we've got that S&P 500, and boy, looks like we're just about flirting with that 50-day moving average.
Well, Eric, exactly. All summer, we've been showing this chart with the 50-day exponential moving average on it. And what we've seen was the pattern develop almost all year, which is that the market trades down to its 50-day moving average, which is just an average price, which is a typical type of a retracement of a prior rise, immediately finds support, and the next leg of a rally would begin off of that pivot. And so we're interestingly at that same inflection point again. And it's really interesting to see whether or not the markets will once again deliver a deja vu event as we approach this area which the ascending trend line and Fibonacci zones all measure to. And what's interesting, though, about this sell-off that's slightly variant from the ones that we've seen in the past is that almost all of the ones we've seen over the summer had some sort of almost 100 S&P point drop, like a one day that was kind of like a market gets spooked, and it gets down to that moving average, and then a reflexive rally almost immediately would begin, and we would be just a new bull run would just have slingshotted higher from that. What's interesting is that the sell-off down to this 50-day moving average this time around has not only now been double the amount of days, but we haven't had a really big down day. It's just been these a slow methodical crawl lower down to these supports. And even yesterday on Wednesday, when we had a reflexive rally, it didn't hold, and the market today is giving almost all of it back. And so it's interesting that we're at the exact same point, but how we got here and the fact that we haven't seen any real heavy selling makes it a little bit different. And it's an inflection point where really, if the pattern persists, then the buy on dip traders should emerge here somewhere. And if they did, there's at least 150 to 200 S&P points upside if we use the analog of any of those prior rallies. At the same time, wouldn't it be interesting if this was the first time we had a break of that 50-day moving average, and especially if it happened here this week where we have the OPEX, where there's a whole bunch of gamma stuffed into these dealer books that could potentially exacerbate a sell-off. Now, that's not a forecast, but it is certainly a reality as we go into Friday. One way or another, I think it's a really interesting moment to almost approach the market in a straddle-style way, which is like, look, if the market is going to rally, then this is actually a great buy on dip point. And if it's going to sell off, this is exactly where it would accelerate. And so it's a very important moment on the S&P chart to watch, just to see which way the next trend emerges.
Patrick, let's move on to page 3 and the euro.
Right. And so we typically talk the dollar index, and the largest component of that and the real driver of the dollar index is the euro as it's trade weighted. And so the euro has been very weak. And what we had today was a legitimate breakdown of the euro, which drove that short-term rise in that US dollar. And what's interesting is, again, we're at a very critical support line. This is where the euro has found lows in the past. So it's in a clear downtrend. It's coming to some key supports. And I think this is going to be a really important moment where we're going to get a tell, because if the US dollar was to break out as the euro breaks a major support line, there's all sorts of intermarket implications to that will send shockwaves through the inner markets. And it's not necessarily that I'm forecasting that, but it's interesting that, as we are at a very critical level on the S&P, we're also approaching some critical levels on a lot of the different currencies and other markets. And maybe September, October will have some sort of a big move. And it's going to be really interesting to see what these currencies do at these levels.
Let's move on to my favorite chart, which is crude oil on page 4.
Right. I just wanted to observe here that crude oil is really decoupled from a lot of the other commodities. It's the one that's running, but a lot of the other commodities continue to struggle, particularly in this period where the U.S. dollar might be strengthening. We're approaching that previous high where we're going to get, I think, at least crude oil bumping its head along that resistance. Not that I would imply anything bearish from that, but it'll be really interesting to see whether the bulls can hold the line up here and whether or not we do get that 52-week high, because really, in my mind, a breakout in crude oil from these previous highs could easily head up to $80+ on a short-term basis. And I know there's some bigger, longer-term targets that you can target, but it'll be really interesting to see whether the oil bulls can build on that. What are you watching for here?
Well, certainly breaking through to new highs above the red line you have on the chart there at $74 is going to be important. I think really, though, it's going to be the trend in inventory drawdowns and how long those big drawdowns last into the fall. Normally, seasonality says when summer, quote, that's air quotes, driving season ends, that we should expect a decrease in demand. If Phil Verleger is right and it's really about summer construction season, I'm quite certain that's continuing through the fall. So it's going to be really interesting, but I think that we're headed above 80 before this year is over. We'll see what happens. Let's move on to natural gas on page 5.
Well, what's interesting about nat gas is that it's one of the commodities here that has actually gone parabolic. And we saw that earlier in the year in lumber prices. And what's interesting is that while natural gas is doing this, there seems to be all sorts of shortages stories that are going around, but it also is driving coal prices. And it's the same time as uranium's running, which we'll talk about in a moment. But one thing that we can really see here, though, is that typically when we get to a parabolic stage of a rise like this, while you don't want to try to be too bold and predict the price level from which the highs will come in, the one thing that we have talked about in the past on the show is that when these parabolic rises tend to occur, they tend to blow off and mean revert often deeply. And what will be really interesting to see is whether natural gas follows that type of an analog. You know, it wouldn't be a shocker to see nat gas print $6 or higher in this impulse. But what's interesting is that once it runs out of momentum on the upside, how deep will it drop on the other side of that mountain? It would be interesting to see whether or not we're going to see $5 and $4 prices on a pullback on the other side.
Patrick, let's move on to uranium on page 6. Holy cow.
Well, exactly. Like in page 6 and page 7 is the uranium stocks with the North Shore Global Uranium Mining ETF that we've featured on MacroVoices in the past. Like, I mean, both of them have pretty much in a span of just several weeks almost doubled in price. And just an extraordinary and very explosive move in uranium and uranium stocks. Again, we're in a situation where it's probably gone too much too quickly on the short term. But one thing that's for sure is that uranium bulls are now finally being rewarded for their patience, and we're seeing that a new bull trend is here. You know, while I anticipate that both of them will likely pause and mean revert some of this rise, I also think that this could be the beginning of a trend that may last for many months and may still go higher. So maybe all dips should be bought at this stage.
You know, Patrick, I just had lunch with Marin Katusa yesterday, and I think we agree with you on this, which is what's going on here is the fundamental drivers for uranium couldn't be more bullish. It's a really good story. However, with a great big underscore, Sprott entering this market, along with this Wall Street bets, propaganda, whatever you want to call it, around uranium, is really, really goosed this thing to the point where there's a significant short-term risk of some kind of blow-off here as that extreme momentum wears off and maybe a retrace. Think what happened to GameStop, the Wall Street bets manipulation stock. You know, they got it way the heck up to ridiculously high levels, but with a lot of up and down along the way. So far, uranium's been straight up. I think we're in for at least a correction, but I do think that we're going much higher before this is ultimately over because they're right about the fundamentals. And of course, everybody's focused on those fundamentals. I still think it was the North Shore Global Uranium Mining ETF advertising on MacroVoices that started this entire trend. of uranium stocks, but that's just my take. Let's move on to gold futures on page 8.
Right. And what's interesting is, we'll talk gold futures here, but gold miners and silver and actually some of the other precious metals have all had a pretty bad down day today, and they've all really reversed back down. I mean, one of the things that I was observing about the reflexive rally that we saw throughout August in gold was that often these have to go back and retest some of those levels. And what we're probably seeing here is some sort of a key retest to just determine whether or not gold is putting in a bottom or not. And so one of the things is not necessarily to make the forecast if it is, but rather to really watch. I think the next week or two of price action in gold is going to be pretty critical, because if the bulls dig in and use this as a buy on dip opportunity, and we find ourselves higher later in the next week or two, then that could actually start to solidify that a change in the trend from what's been in place for almost a year plus now might actually start working on the upside. But I think it's very early to make that call. But I think that the kind of big tell is going to happen here in the next week or two.
Is this an inverse head and shoulders that's formed since the middle of June here?
Well, if it starts to rally off this point, many technicians will see that pattern for sure, and that's why I think whether or not gold makes it all the way back to its previous lows, or whether it turns off of this little dip, is going to be a key part of determining whether that is a turn point.
Let's move on to page 9, and copper futures still consolidating.
Yeah, what's interesting is that, well, while we see oil breaking out, it's one of the few commodities that is. I mean, and uranium, of course. But when you look here, copper had that extraordinary bull run that ran through the first half of 2021. But really, we've been now in a multi-month consolidation. And what was really interesting is last week we had a really nice bullish breakout attempt to the upside of copper, and the bulls couldn't hold it. And so far, they've given back the entire breakout attempt. At a minimum, what that is telling me is that it just might be a little bit early for the next bull run on copper to get in started. It'll be interesting to see where and how the supports hold during these consolidations. And we'll be looking for when there is a bull breakout that sticks. But right now, so far, the one that started last week has not been sticking.
Now, Patrick, when we talk bond yields on MacroVoices, we normally start with the U.S. 10-year Treasury. How come we're looking at the 30-year Treasury here on page 10?
Well, it's interesting is because when you go farther out on the yield curves, you're actually seeing that they're becoming actually less and less responsive to these inflation pressures. And what's interesting is that 30-year yield still hovering around 188 here, well under 2%, in spite of the fact that inflation is probably running the hottest it's been in a very, very long time. And it's interesting to see that it's just simply not responding. And one of the ways to kind of reflect on that is because the 5-year yield has been somewhat working higher. When we look on page 11 and look at the 530s yield curve, what you can see here is that this continues to decline. It's almost like the market is really almost buying in the transitory inflation argument, at least reflected in this. And really, anyone who's been predicting inflation and using the bond market as the way to express it has really not been rewarded at all for that, making that call right. And it's interesting how the bond market continues to manifest itself. But what is the most interesting about that is if you go on page 12, where we show the iShares TIPS Bond ETF, one of the best ways then to reflect or capture that has been to be long TIPS, because they're actually pricing in that inflation versus those 30-year yields and 10-year bonds and so on that have not been reflecting that. And so it's going to be really interesting to me to see whether the TIPS continue to outperform here in the next little while.
And listeners, if you enjoy Patrick's chart decks, be sure to check out page 13, where you can get a free trial of Big Picture Trading, Patrick's service, and get Patrick's webinars every single day of the week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.